right, so I work for Ernst & Young, which you probably all think is a big four accounting firm, which it is, and you're wondering, you guys do sustainability? And we do. We have about 1,000 people around the world that's all we do is focus on sustainability. But one of the most important things we do is we build a better working world, and it's our purpose. It's what gets us up in the morning is that we're building a better working world. And one of the ways that we do that is we provide transparency to financial markets, and we help investors have useful information to make good decisions about the investments that they're making. And we believe that that helps the financial markets work, and when the financial markets work, a lot of the rest of the world works too. And so that's why this is an important part of what we do. My agenda for today is, this is all the stuff because we're a big four accounting firm and we have to say that stuff. So we're going to talk about, do investors care, and why? How do we know that investors care? How are companies reacting to the fact that that investors care? What are some of the standards? You probably know them, so we'll go quickly through that. Talk a little bit about the so what and what's next. So I have an hour and a half of content. You guys okay with that? All right. All right. So why investors care and how do we know that they do? So if any of you go to the CFO of your company and you say, hey, we should really focus on sustainability because investors care about sustainability, the first thing they're going to say is, I have never once had anybody ask me a question at our quarterly earnings call. And the truth is, they probably won't, because on the quarterly earnings call, they want to know about quarterly earnings. And sustainability almost never affects quarterly earnings. And so it's really not the case that that's where they talk about it. But there are a lot of other places that investors do demonstrate why they think this is important. So I'm going to tell you a little bit about it, starting with why investors care in the first place. This is like my favorite slide. I think I have used it in virtually every presentation I've ever given. So if you've seen me speak before, you've seen this slide. This is a survey from Ocean Toma, which is a merchant bank and a sort of a research house. And what they say is in 1975, about 82%, 81% of a company's market cap was made up of physical and financial assets. Things you could count, things you could touch. A company's market cap, the value that the market gives to it, was made up primarily of those types of things. Fast forward to 2015, that percentage has almost completely flipped to now where 19% of your company's value is made up of physical and financial assets. And the rest of it is made up with intangibles and things that are much harder to measure, like human capital and intellectual capital and brand and sustainability and risk management and things like that. Things that are very, very hard to measure. So, but this is why investors care about sustainability and non-financial information, because the market cap, the value of their investments, is very much made up of things that are not typical, that are some of these other things. You guys want an example of this? I used to tell the Goldman Sachs story where the guy from Goldman wrote a letter to the editor of the New York Times, and he said, our culture stinks and the people hate working here, and there's going to be a whole bunch of turnover. And right after that, Goldman's market cap dropped by $2 billion. One letter to the editor. But here's a better example for you today. What do you think happened to VW? The day the story came out, $15 billion in market cap. $15 billion of value gone because they were untruthful. So do you think that investors want you to be transparent, to have 140-page GRI reports? Because they need that information to assess whether or not a company's a good investment. It's a great slide, isn't it? I wish I made it up. It's like these people from Ocean Tone.
Yes.
Are they?
Yes, they are.
Okay. I can't tell you how many people reviewed this presentation and nobody caught that. But thank you. All right, well, check this one out. So how else do investors tell us that they care about sustainability? Well, shareholder proposals are another way that they tell us that they care about sustainability. In the 2014 reporting year, 60% of the shareholder resolutions came from environmental, social, and governance issues. More than half were related to these sustainability or corporate social responsibility issues that we all deal with every day. That's big. That's a really big number. The other thing that's important is this chart right here that talks about what percent of them gets how much support. So what we know is that board of directors start to care when the investor support gets to about 30%. Okay, so if 10% of your investors care, the board doesn't care. If 20%, they still don't care, they might at least read it. But at 30%, they start to care. And you'll see this chart, it's kind of been going up on a pretty decent level all the time. So what happens to these shareholder requests? Sometimes they're just let go. So somebody will call a big company and say, we really think that you ought to create a GRI report or report to CDP or something like that. And instead of actually filing that shareholder resolution, they're able to, they say, okay, you're right, we should do that, and then they just withdraw. So that is what happens to a lot of them, but more and more they're coming to a vote. So shareholders are starting to stand up for what they care about. Again, they're still not asking questions at the quarterly earnings call, though. Okay, this is the interactive part. 56. 56 is the number of companies that file an integrated report, a reasonable water use ratio for a packaging company. Oh, you see, well, let's see if you would know that. The number of countries whose governments or exchanges require or highly recommend sustainability reporting, or the percentage of water to bourbon in a mint julep.
All of the above.
Well, first of all, there's like this much water in a mint julep. Man, these little old ladies from the South that sit around drinking mint juleps are drinking straight bourbon with just a splash of water. Exactly, exactly. It's the number of countries whose governments whose highly recommend sustainability reporting. So this is the other driver, right, for increased transparency, is that either the country or the stock exchanges are starting to say, we want to have this information. Even in the United States, the New York Stock Exchange and the NASDAQ are highly recommending that companies report their sustainability. Now, they're not quite ready to go out and say we're going to require it. And the reason is they already got so burned with Sarbanes-Oxley that companies don't want to go public because of Sarbanes-Oxley is such a pain in the butt. And now you're telling me I have to report sustainability too if I'm a publicly held company. So I think you'll see this number increase when the exchanges kind of all get on the same page. But until then, you're seeing more and more efforts around this. Another effort that you probably have already heard of, the INCR, Investors Network for Climate Risk, is an organization pulled together from the Ceres group, the NGO that focuses very much on business and sustainability. And they basically have a resolution that says, we want companies to report on their materiality. We want them to disclose their issues. We want them to kind of double check against the GRI. They don't have to have a GRI report. And we want the exchange to help monitor that on these issues on the side. And we want them to report or explain why they can't, is what this resolution did. There was like 175 investors that signed on to this resolution, and they're going to the exchanges and asking for this. So again, you're seeing more and more investors care about this. Oh, another question. 61. The number of NGOs that are focused on carbon reduction. The current temperature outside, that might actually be true, but that's not the answer to my question. Percent of investors that consider sustainability information relevant in all sectors. and the percent of companies that say their shareholders are the primary audience for their sustainability report. That's a good guess because almost always the longest answer is the right answer when you do multiple choice. It's the second one. So we do a survey every year of institutional investors, and we ask them a number of different questions about sustainability and what's important to them. So this is like so hot off the press. You can go get it on our website, or you can give me your business card and I'll send it to you. But what this to me is really fascinating. So first of all, if you look at the 2014 bubbles, the gray ones, versus 2015, 2015 is bigger on virtually every issue. And sometimes it's by a pretty big number. So the first one is consider non-financial data relevant in all sectors. So in 2014, it might have been more mining, utilities, those kinds of organizations, and now they're saying all sectors, this is important information to us. Using a structured methodical evaluation, gone from 20% to 37%. Believe companies are motivated to report it because it helps demonstrate that they know how to manage risk. I like that one a lot because I actually really highly believe that if a company is managing sustainability, they're managing their risk better. So your takeaway here, every single issue is becoming more and more important to the investors this year. And this is like over 200 investors from around the world. So the other thing is, another way to demonstrate that these companies are using, or investment houses are using sustainability information when they're making decisions, is this is Bloomberg, and you probably are all familiar with Bloomberg, where they report all kinds of financial information. They also report 100 different sustainability indicators on 10,000 companies. So the analysts that are sitting on their computers all day and looking at what companies do I want to invest in have access to 100 different sustainability indicators about your companies that they are using to make decisions about investments. And the interesting thing, again, is the increasing use. So when they first brought this information out in 2009, they had 2,400 unique users who accessed, investment analysts, portfolio managers, people like that. This last year, 17,000. And just from 2013 to 14, an increase of 76%. Another demonstration that investors are using this information to make decisions. I guess actually this just means they're accessing the information. I guess they may or may not use it, right? But I'm sure they are. Why would you access it if you're not? So one more. This is back from our survey again because we have the cute yellow and gray bubbles. How do you and your investment team evaluate non-financial disclosures? How do you use that information? And again, going from we kind of use this information, but now we have a structured way to look at this information. So much more formal analysis of sustainability information. Also relying on some of these external organizations like the UNPRI, the Principles for Responsible Investing. That's moving up. The things that are moving down are that we're evaluating this informally or that we conduct little or no review of sustainability information. I think it's pretty compelling.
Do they say on there, or is one of the indicators if these investors or companies are using off-balance sheet type financing or not, or energy efficiency projects through like shared savings agreements or ESAs?
I don't think it goes to that level of detail. The one additional issue that's really discussed that I don't have in this particular presentation is stranded assets. That's a really big issue that investors are looking at these days, but they didn't really ask that question. So this chart, the yellow, this is the right colors. Yellow is reconsider investment. The light gray is no change in my investment plan, and the dark is I would actually rule out this investment, is for all of these different topics, how would it change their investment decisions? So, for example, this is a risk or poor history of environmental performance. 10% would just completely say, I'm not going to invest in that company. And 75.6% of the investors would say, I'm going to really rethink whether or not I'm going to do that. So, basically every one of these issues, risk from resource scarcity, supply chain risks, risk from climate change, human rights risks in the operations. So it really is, according to our survey, it is changing how investors look at companies and how they make decisions. And just because I work for an accounting firm, I have one more chart because this is what we do. The other thing is that investors vote with their dollars. So this is an aggregate of the responsible investing group. So these are people who signed up for PRI. They're the impact investors, the responsible investors. So that group collectively invested $3.74 trillion in 2012. 2014, a pretty huge increase to over $6 trillion. I venture to say that number is only going up, that investors are particularly interested in this. They're investing in these sustainable companies. And again, going back to my personal opinion, part of it is because managing this stuff is also managing risk. And if you're going to invest in a company, you want to invest in a company that manages risk. So are you convinced? You guys are convinced that investors care about this stuff? They do care about the bottom line. But this helps drive the bottom line, I think. And that's something that Ed actually didn't bring up at all. Everything they do at UPS is like so fantastically connected to bottom line results at UPS, which is part of why sustainability is so exciting there. So how are companies reacting? So first of all, companies are reacting to more than just investors. So they are certainly reacting to their regulators, to their communities, to their employees, to a wide group of stakeholders. So they are thinking about what investors are interested in, but they're also looking at this much wider group of stakeholders because all of these stakeholders can impact the company and the decisions that they make. And I keep walking too far right. Oh, I have another question. Okay, 15. 15, the age of my youngest child, the number of NGOs that are focused on carbon, the current temperature, that's a gimme. It's not that. A percent of companies that say their shareholders are their primary audience for their sustainability report. I already gave you a clue. It's almost always the longest answer. That's the answer. So this demonstrates that they really do their sustainability reports for their shareholders, but probably more importantly, their customers and their employees as well. This data is a little bit older. We did a survey a couple of years ago. I don't think it would change substantially. All right. So how familiar are you guys with all the different standards that are out there? So before I spend too much time, like GRI and SASB and IIRC, we'll just do a quick overview and go like this if you already know about all of this. So one of the things that investors really like is standard and comparable information. That's why these standards matter, because they want to be able to compare company A to company B. They want to know UPS's carbon intensity versus FedEx's and DHL's carbon intensity. And personally, I think that's a pretty tough comparison to make because all companies are so different. But these standards are really attempting to make information more consistent. So you and I as consumers and you and I as investors and these institutional investors can make comparisons, and make decisions about the companies that we want to do business with. So what's different about all these standards is scope, content, and stakeholders. So the GRI is focused on all the stakeholders, that whole big messy chart that I just showed you guys. GRI is trying to make all of them happy. They cover just about every particular issue, and it's a global standard. So it's probably the most encompassing and has the most information in it. SASB is the Sustainable Accounting Standard Board, cleverly named after the Financial Accounting Standards Board because they're trying to connect to the SEC. What SASB is trying to do is identify material issues by industry that they can eventually make required reporting to the SEC. They have a lot of heavy hitters. They have former SEC chairs, they have Michael Bloomberg, they have a lot of money behind this and a whole process to identify material issues by sector that they want to make required reporting along with your 10K. That's a US based only, but it does cover multiple issues. And it's really all, it's environmental, it's social, it's, you know, like a material issue for the pharmaceutical industry, for example, is access to medicines. So it's definitely not just the environmental issues. The IIRC is the International Integrated Reporting Council, and what they want you to do is report your financial information at the same time in the same document that you report your non-financial information. So if you think back to that Ocean Tomo slide that had all these other capitals, manufactured capital, natural capital, intellectual capital, those things, they want you to report all of those things into one report. This is much more common globally. There are very few companies in the United States that are doing this, but it's certainly a trend, and part of the challenge is, for all you people who are collecting data, getting the data in time to hit your financial statements at the same time. I have very few clients that can report their sustainability at the same time they send in their 10K because it's so much harder to collect all this other information. But that's the goal of the IIRC. And then finally, the CDP, I'm sure everybody knows about. So that's global, you know, started with carbon, has water, forestry, et cetera. So that's the scope of that. But all of these are intended to make information more transparent and more comparable, and the investors like this stuff. They're particularly interested in SASB because SASB is only focused on what investors care about. They don't care about communities or governments, just what investors want. The big difference, or the big consistency, is that all of them are focused on materiality. So determining what's most important to your stakeholders and what's most important to you is a part of virtually all of these. And Ed showed his materiality matrix. And I firmly believe that it's an excellent tool just for reporting, but it's also an excellent tool to figure out where do I spend my time, money, and efforts related to sustainability. So this is one thing that no matter what standard you're looking at, you're going to focus on materiality. Companies always focus on the stuff that's in like the upper right-hand corner. You know, obviously in a 2x2 matrix, this is the cool stuff up in the upper right-hand corner. What I always think is interesting is what falls here that's important to the company, but actually isn't important to your stakeholders, and then vice versa. What's important to your stakeholders that's not important to you, and where are you missing the boat? But anyway, that's sort of an important thing. This is another way that you can look at it. There's so many different ways to do it. There's no one right way to do materiality. One of the ways I saw recently that I really liked is the size of the bubble was based on the perceived ability for the company to make an impact. So could they make a big impact on something, then it was a much bigger bubble. If it was something they really couldn't affect, then it didn't. I liked that way. '72.
The age of your youngest child.
Watch it.
We were friends.
We were friends. We are no longer friends. Although I do have my age in dog years as one of the choices up there. But watch it. Watch it. All right. Reasonable number of lost days. The percentage of Global 50 that focus on water reduction, the percentage of S&P 500 companies that published a sustainability report. And again, oh, it's not the longest one. It's the last one. It is the last one. So that's this chart down here. That one up there. About 72%, the number of S&P 500 companies that publish a sustainability report. Globally, though, this one's huge. 90% of the world's largest 250 companies provide a sustainability report. A majority of them do use GRI. And I couldn't argue with that. Only 10% of the world's largest companies do not issue a sustainability report. Ed mentioned that they have their report assured. That is a growing trend in the United States, but not a really big one yet. So, but I can tell you that for the companies where we provide financial assurance, they like to be able to say, we trust our finances to E&Y, and we think that our non-financial information is just as important, and we trust them to look at that information as well. And that's the story at UPS. Deloitte does both. So I think it's a good story. So those are the trends that we're seeing. And so the question is, so what on all of this? So first of all, we're convinced that investors care. We understand that standards really help make the information usable, right? So why does all of this matter? You gotta know. You know, I keep telling my clients, I almost don't care if you report. I care that you know this information and you're making management decisions using environmental, social, and governance metrics, that you have all of this information. Now, your investors want you to make it public so they can make good decisions. And as a consumer, I want people to make this information public so I can make good decisions as well. But it's so you know what's coming, and that's why it's important. It's why it's important for y'all to gather this data so we can put it into reports and do analysis on it. So here's what we see. We don't think this need for transparency is going to go away. We think it's just going to increase. People are going to be asking more and more information, and just wait, they're going to start asking about externalities now too. You know, what would it be if there was a carbon market? How much would you have to pay then? Or what if there was a real price on water and not this made-up price that we know doesn't actually reflect the value of water? So we think that the stock exchanges will continue to ask for more and more information. We think that will continue. I'm not going to bet of when I think the United States will put that down. And we think that the companies will begin to have a better understanding of all of this information and connect it together too, not use carbon information separate from social impact, separate from economic impact, that they'll figure out, or hire EY, right, to help them figure out how to use all of that information together to make good decisions. So we see that that's coming. The leading companies, the ones that you've heard about, are doing that more and more.